Hello, hi. Welcome to today's free webinar. My name is Dr. Lawrence. I'm a business development and management consultant, and I've been in the business management consultant space for the past decade, managing your business finances and how to effectively manage all your business cash flow. Now we'll jump right in. Business today has really changed compared to business in the last decade or in the last 30 years or 20 years thereabout. Why? Because the introduction of new technologies and tools that aids ease in operations. This change requires us as people that we must always be up to date with the modern ways of doing business so that we can stay relevant to business. So there are so many technologies that are up now. We have new mobile applications that you can use to carry out your business transactions. They have other types of technologies that are available. But what has changed? What has really changed the business is that there are new classes of business that is erupted per time. Now, an example of this type of businesses includes social media marketing, affiliate marketing. And these are new classes or categories of businesses that were not in existence 10 years back or 20 years back. Now, the reason is because there's now an ease of access to the internet. So a lot of people are cashing in and they're bringing in their business skills, their business know-how into the internet world. There are new mobile applications that help to aid your business, like the Google Sheets, the WPS on your phone helps to aid your business. Cash flow has been much more liquid right now than it has ever been. And there are multiple payment channels that you can use to receive payment, irrespective of your location all around the world. People are now much more inclined to doing business. But the thing is this change that has come to stay, how long will this change stay? And would it always keep revolving or evolving as time goes on? The truth is yes, because there is only one thing that is consistent in life, and that is change. So as long as we're on earth, men would always innovate. Men would always build new businesses. Men would always bring new things. Now, there's one thing that you must know in every business: cash flow is the lifeline of every business. So the cash flow is the lifeline of your business. Cash flow is king, as we all know. And with cash flow, you can actually get into new markets. There are so many benefits that comes with it. You get into new markets. You can expand your product base. You can leverage more with the banks. Now, the banks believe that businesses that has a good and a healthy cash flow system, as well as a very healthy turnover per time in their businesses, they believe that these businesses are creditworthy. And so they can always give you money to do your business. So you see some companies today, they start up with their own funds, and 3 years or 2 years along the line, they've switched from using their own money to do their businesses to using bank money. And when they finally grow their funds to a very large extent or a very large state or capacity, they switch back to using their funds again. That depends on the financial model that the company operates. Now, cash flow also gives you the benefit of having a very fluid lifestyle, in the sense that you can easily fund your lifestyle. But with this cash flow, with this excess money that's available online, the tendency for you to misappropriate funds is pretty very high, especially if you have no knowledge about what it is to have financial structures in your business. Today, we'll be talking more about how to create a financial structure in your business using budgeting, effective budgeting, and effective cash allocation. Classifying your accounts would be a very good way for us to start this topic. Now, you need to know that in classification of your accounts, there are 4 major accounts in every business, which includes Your expense account, also known as your operations account. Now it covers or it umbrellas all expenditures that happens in your business. You have your savings account, actually used for emergency days, the days when your operations account is not running at full capacity or something happens along the line and you need to supplement for the time being. So you have your savings account to come to your rescue. And then the salaries account. The salaries account, they can also be classified as a futures account because every money that comes into your salaries account is going to be paid at a later date. And these people that are working for you, you don't want to give excuses that you don't have money to pay them because maybe business went bad or sales didn't go as planned. No, you want to be a responsible business owner or a responsible entrepreneur. So what do? You have a separate salaries account. And then you have your revenues account. The revenues account is the account whereby every raised capital or every raised monetary resources for the business comes into. So you receive money using your revenue accounts and then you distribute or reallocate this money in percentages to your operations or expense accounts, to your savings account, to your salaries account, and then to your investment account. Now, the investment account is usually very much attached to your savings account. But why do you really need to classify your accounts? What are the benefits? The benefits of classifying your accounts is that it gives clarity to your cash flow or your cash movements. It helps the accountant or your auditor that is going to be auditing your accounts gain more understanding about the state of your business finances, about the things that you're using money for, about your cash flow. It also helps you curb excess impulse expenditures. So you don't just spend on the go or spend because you feel that there is a need that needs to be met. If everything is on a budget, you don't spend on the go. It also encourages proper budgeting and organization to your finances. That's why you need to classify your accounts. In classifying your accounts, it helps keep your account statement healthy enough for investors to want to fund your business. Because if you're looking to grow so large, you will definitely at one point in time need investors to come into your business. And by the time they ask for your numbers, the best thing you can do for yourself and for the growth of your company is to present a classified account. Now, how do you achieve a very classified and beautiful account? It's by budgeting and cash allocation. Budgeting is simply an estimated value of your revenue that is needed for both expenses and for other things in the company over a specified future period of time. And budgeting is usually reevaluated on a timely basis. So budgeting is an estimated amount that is needed for either an expense or for savings. So budgeting, because it's an estimated amount, what is the benefit of budgeting? The major benefit you get with budgeting is that budgeting helps you to buffer your cash reserves, your cash flows. For example, if you have a budget to buy a stock worth 2 million naira, and then you budget 2.8 million naira for it, the 800,000 naira on top of your 2 million naira serves as a buffer for your budget or for the amount you need in buying your stock, just in case there is fluctuation in currencies, value, or something happens in the market and the prices has changed. Now, cash allocation on the other end is the directing of monetary resources to an approved budget based on the company's set goals and objectives. So for cash allocation, you're looking at the directing of the monetary resources to approved budgets already. Budgeting is an estimated value. Allocation, cash allocation, is the direct allocation of monetary resources. This is the BCA chart, which I call the budget and cash allocation charts. Now, how does it work? You have your revenue, which is about 100%, and then it's budgeted down to expenses, salaries, savings, and investments. It could be on the 50%, 20%, 20%. It all depends on what you really want. But let's use a case study, for example. Using the case study, Hugh Parker's Enterprises, which is located in Lagos, Nigeria, is starting a new business here with a revenue of about 7.5 million naira, which, according to today's exchange rate, would sum up to about 10,000 US dollars. The company plans on renewing its shop rent worth about 500,000 naira, that's 500,000 naira, and retaining the old staff, Chinenye, whose salary is 30,000 naira per month. The CEO, Mr. Parker, has a take-home pay of 100,000 naira per month, while other utility bills sums up to about 5,000 naira. And then at the previous year, they had a goods worth about 2 million naira, which on turning over produces a net profit of 650,000 naira per month. Now, design a budget and cash allocation chart for the new business year for Hugh Parker's Enterprises. Now, the BA chart for Hugh Parker's looks like this. Now, there's the 7.5 million naira, which is the 100% revenue of finances that was sourced, either personal finances or bank loans or whatever it is. This is then budgeted based on percentages. Expenses takes 50%, salaries takes 20%, savings takes 20%, investment takes 10%. So we have for your expenses 3.7 million naira, which covers both for 2 million naira that is needed for you to stock the Hugh Parker Enterprises, and then an extra 1.7 million naira, which acts as a buffer and also as an extra cash to flow into other parts or other accounts that needs extra money. Now the salaries is 1.5 million naira. You notice from the information given on the case study that the CEO actually has a take-home pay of 100,000 naira per month, and that translates to 1.2 million naira per year. While Chinenye, the worker, has a take-home pay of 30,000 naira per month, which translates to 360,000 naira per year. So it means that the salaries account will need an extra buffer of 60,000 naira from the expense account to balance out. Now you have your savings, which is 1.5 million, and your investment is 750,000. The good thing about the savings is this. Why do you need a savings account? Like we said, it is an emergency account. When the expense is, or the operations account needs a buffering. For example, there was an issue in sales and sales didn't go out well for that year. And for the upper year that's coming, stocks need to be maintained or salaries need to be paid. But enough profit wasn't made the previous year. So what happens? Cash from the savings is then moved to operations. That is called reallocation or reallocation of funds. So it moves into this to the operations account to aid the operations, which actually brings in profits to the company or to your business. Now, in some dire situations whereby savings has been depleted, what happens? The CEO or the person in charge of the financial manager then reverts to the investments. And then cash is moved from the investment accounts to the expense account, where operations is then funded fully and then the business keeps running. On a very, very severe note, on a very severe case, where it now looks all bad and it looks as if the company is going to remodel or change their style of operations. What happens? You start hearing of companies, they're doing layoffs or mass layoffs. And the reason is because they are trying to cut down on salaries so that that extra cash that goes to salaries can be reallocated back into expenditures or into operations for the business to keep on running. So when you see companies saying that they are downsizing or they are dropping people, it's because of this model. This is how it works. So when you hear companies say they are laying off 1,000 staffs, it's either because the model is faulty and they're trying to rework the model, or two, there's an issue with earnings from the operations. And so they've thought about moving down some people so that they can refund operations and get back to business. This is a simple way for you to hold or manage your business accounts without having so much force about it. And remember, your personal account is usually very separate from your business accounts. And whatever funds you get in your personal accounts comes from your salaries. I hope you've learned something today. I'll use this medium to actually invite you to register for our next course that is coming up, the Finance Intelligence course. And it's for business owners, for founders, for entrepreneurs who are interested in getting their finances right from the very start. We'll be talking about extensively how to raise funds the right way for your business, how to start your business from as little as possible and scale up in a period of a year or 2 years. Now, a lot will be taught in the Finance Intelligence Masterclass. I hope that you'll be around and I hope to see you there. Thank you. God bless you.